Yield is a liability if it does not outrun inflation. With the Monetary Authority of Singapore revising core inflation forecast to 2.5%, that 4.7% yield hurdle is no longer just a suggestion for your portfolio. It has become a survival metric for every retail investor in 2026. Today, we are performing a forensic audit to see if Keppel DC REIT's 13.2% jump is a true sanctuary for your capital or just a temporary peak before the fall. Let's be honest, your safe yield might be shrinking faster than you realize as mass raises those inflation forecasts. In this environment, yield is a liability if it fails to outpace the rising cost of living. The revised core inflation rate of 2.5% has changed the math for everyone. We are moving past the era where any dividend was a good dividend. Now we look at the 4.7% yield hurdle as the line in the sand for survival in the Singapore market. Taking a look at our market forensics dashboard, the STI index is sitting at a bullish historical peak of 5,022.49. While that looks good on the surface, the underlying rates tell a more complex story. The 6-month T-bill is verified at 1.47%, and the one-day SORA is at 0.9324%. With core inflation rising to that 2.5% ceiling, our static forensic floor remains at 3.2%. This dashboard is the baseline we use to judge every counter today. Turning to our first counter, Keppel DC REIT is showing a first quarter distribution per unit of 0.02833, which is up 13.2% year-on-year. Distributable income has grown 20.7% to $74.6 million. However, at a price of $2.37, the annualized yield is 4.38%. This clears our 3.2% floor but actually falls below our 4.7% hurdle. Most critically, gearing has hit 35.3%, officially breaching our 35% ceiling and putting growth headroom in the red zone. Looking ahead for Keppel DC REIT, we have to consider a forward scenario where a 10% energy cost hike could pressure net property income. The saving grace here is the 45% portfolio reversions expected in financial year 2025, which confirms their pricing power with hyperscalers. For a retiree relying on these dividends, that 13.2% distribution bump is vital. It comfortably outpaces the inflation ceiling, which means you are actively growing your purchasing power rather than just trying to preserve it. That 45% rental reversion is what I call the AI tax in action. Hyperscalers desperately need this data center space, and Keppel has the power capacity they crave. This distribution growth is running nearly 5 times the inflation forecast, which bolsters its status as a sanctuary. But we cannot ignore that gearing breach at 35.3%. It is the heavy counterweight to the growth story. Sometimes you pay a premium for a moat that actually works, but you must ensure the drawbridge is still up. Quick pause before we get to the core of the math. Let's talk about you. You aren't here for the kopi tips or the hype. You're here because you want to understand the forensic truth before you commit a single dollar of your capital. But here is the uncomfortable truth about how the algorithm works. It doesn't know you are watching carefully. It doesn't know you are thinking critically. It only sees one primary signal, whether you've hit the subscribe button. Every forensic investor who watches without subscribing is effectively invisible to the machine. If my work has ever helped you identify a risk or calculate a margin of safety, hit that button now. It isn't for me. It's to tell the algorithm that data-driven SGX analysis deserves a seat at the table alongside the noise. Now, let's get back to the numbers. Moving to our second counter, StarHub is ceding majority control of Ensign Info Security to Temasek for $115 million. This deal allows them to book a $200 million fair value gain by 2026. At a share price of $1.08, the trailing 12-month yield is 5.74%. This decisively clears both our forensic floor and the 4.7% hurdle. The risk audit shows that exiting cybersecurity narrows their moat, leaving fewer pillars to absorb pressure if telco margins take a hit. The $115 million cash injection from this deal provides a significant buffer for StarHub. The big question for management is whether they redeploy this into 5G infrastructure or return it to you via special dividends to defend that 5.74% yield floor. For a 50-plus investor, this looks like a de-risked balance sheet play. The cash supports their core business, and for now, the yield holds well above our forensic threshold. This Temasek handoff is a classic capital discipline move. By booking that $200 million gain, StarHub is clearing the path for a much leaner 2026. That 5.74% yield makes this counter worth watching very closely as it clears the hurdle. The real story isn't what they sold, but what they plan to do with the proceeds. In a high-inflation world, cash is a better weapon than a complex subsidiary, but only if management knows how to use it. Our third counter is Yangzijiang Shipbuilding. which recently incorporated a $100 million subsidiary for vessel repair in China. This was funded entirely from internal resources, which signals a very strong balance sheet. However, the annualized yield is only 2.96% at a price of $4.05. This fails to clear our 3.2% forensic floor. This counter is strictly a capital growth and cyclical play, not something you hold for steady income. In the forward view for YZJ, vessel repair commands much higher margins than building hulls. This is a deliberate shift to service-driven revenue before the shipbuilding cycle peaks. If you are an investor at the local wet market looking for dividends, this is not the play for you. They are reinvesting cash to build a stronger moat for 2027. There is no immediate dividend impact here, but the strategic direction remains sound for long-term growth. To wrap up the bottom line, Keppel DC REIT has strong operational performance, but the yield has compressed to 4.38%, which is below our hurdle. StarHub's divestment has cleaned up their balance sheet, and that 5.74% yield holds above the forensic threshold. Yangzijiang then is a capital growth play that sits below our floor, making it the wrong category for income-focused investors. Remember, any yield below 4.7% is operating on borrowed time. The window is already open, but it closes fast. In this current market, the difference between a sanctuary for your money and a yield trap is often decided in a single trading session. By the time this analysis reaches you as a free subscriber, the entry window I identified has often already closed. You need to be moving at the speed of the market, not reacting to old news after the big players have already made their move. Elite subscribers get this data when the numbers still matter. For $9 a month, which is less than a kopi and kaya toast set at Raffles Place, you get 0-day forensic breakdowns. Stop being the exit liquidity for institutional players and start being the analyst yourself. You get the full red zone watch list and institutional grade cheat sheets to guide your decisions. The goal is to see the flags before they hit your portfolio. Here is the final forensic verdict. Keppel DC REIT offers a 4.38% yield, which is below our hurdle and carries a gearing breach at 35.3%. StarHub clears the hurdle with a 5.74% yield and a fresh cash injection, though execution risk remains. Yangzijiang Shipbuilding is for capital growth only, failing our floor with a 2.96% yield. With inflation at 2.5%, that 4.7% hurdle is your survival metric. This content is for educational and informational purposes only. Iggy is a retail investor applying forensic analysis publicly, not a financial advisor. Nothing here constitutes advice to buy, sell, or hold any security. All data sourced from public filings, unverified data is explicitly flagged. For decisions involving CPF, SRS, or personal capital, consult a mass licensed financial advisor.